Welcome to Deloitte's Debrief Tax Webcast series in Asia Pacific. Our webcast today is from Transfer Pricing series and is titled Parental Corporate Guarantee Changing Landscape. My name is Sanjay Kumar and I'm the tax partner based in Deloitte India office at Delhi. I have the pleasure of hosting today's webcast. I have four speakers with me today: Oki Olivier, Avik Bose, Trina Maitra, and Thepin Key. Oki is a tax partner based in Deloitte Australia office at Perth office. Avik is a tax partner based in Deloitte Singapore office. Trina is a tax director based in Deloitte India at Calcutta office. And Thep is a tax manager based in Deloitte Singapore office. You may access our bios on the left side of the screen. Before I introduce the agenda for today's webcast, I would like to take a moment to highlight some of the features of our webcast console. First, all users are on listen-only mode. If you have any content-related question, you can submit that at any time in the Q&A box at the bottom right of this screen. We'll do our best to respond to your questions during the presentation. Second, all PC users can maximize or minimize each box at their convenience during the webcast. You may also explore the icons at the bottom of the screen. If you want to download today's slides and related publications, please go to the Downloads and Links box. Mobile device users can view the slides and answer the survey on screen. Third, if you require an attendance record for this event, you can download your CP certificate by clicking the Request CP icon at the bottom of the webcast console. Now, let me give you an overview of the topic we intend to discuss during this webcast. First, I'll try and give you a general trend on guarantees and what are the chargeability aspects of that by way of an introduction to the topic. I'll be followed by Oki, who would delve into what OECD guidance suggests on parental guarantees. His presentation would include the 2020 OECD paper on financial transactions. After this, we will take up country practices in some details. Trina will cover India, Japan, China, and Hong Kong and Korea. She will be followed by Avik and Thep. Avik will cover Singapore and Malaysian practices, and Thep will cover Indonesia, Philippines, and Vietnam. After that, Oki will come back to give you his perspective on Australian and New Zealand country practices. We'll also have some polling questions in between, which I encourage you to fill in. So let me start with the general business trend of guarantee transactions. Accessing finance is certainly a challenging task for companies world over. Challenges could be in terms of size of the firm, looking for loan, and high risk perception attributed to them, asymmetry of information, and can also be lack of collateral. In the context of multilateral corporations, related parties often come forward to provide guarantees. This is quite often seen in parent-subsidiary context. So a parent may decide to provide guarantee to a loan being taken by a subsidiary. Situations of providing guarantees could also be in the context of one affiliate in an MNC structure guaranteeing another one. Many times, these transactions are considered a shareholder activity. Tax authorities, however, give the example of unrelated party transactions where guarantor would charge for the guarantees. Given such a divergence of perspectives between the taxpayer and tax administration, it is also seen many times that M&Es may not have a policy to charge in most cases, unlike most other related party transactions. It is also that many countries do not have a specific guidelines for appropriate benchmarking of these important related party transactions. In part, that could be because there are certain difficulties to classify guarantees clearly as a rendering of a service or provision of debt or an insurance arrangement in which one party receives a regular payment for undertaking risk on behalf of another one. It is important to distinguish that a guarantee provided to banks for fund-based or non-fund-based guarantee financial arrangements are financial guarantees, whereas performance-based assurances or guarantees for non-financial obligations are termed as performance guarantees. Again, the latter being far more complex when it comes to valuing the risk and pricing it. Chapter 10 of OECD guidelines does provide a framework giving different methods for accurately delineating and pricing a financial guarantee. And that has brought the attention of the topic at hand, including a general expectation that tax authorities may rely on these concepts when they audit a taxpayer for these transactions. We can move to the next slide, please. Guarantees, as I said, financial or performance, can also get muddled in a debate on whether multinationals are providing passive association, including whether the guarantee activity, as I indicated earlier, is more of a stewardship activity that benefits a shareholder. Questions of implicit guarantees are also raised as activity could benefit the recipient of the guarantee implicitly. All these do present certain challenges. Some important points to ponder, which have been evolving from various jurisprudence, are whether pricing should be aligned with the benefits so that it is important to understand what the specific benefit was provided. Second could be whether third parties would be willing to take such guarantees. Third one could be whether guarantees are provided in a capacity other than that of the shareholder. And what is typically seen that guarantees are a condition precedent. And the fourth one, what are the risks of the guarantor? Considering now that we have an OECD paper and more firmed up regulations and guidance and jurisprudence in various countries in the AP region, it would be useful to move forward and discuss that. Let me ask Oki to start the proceedings and give us a perspective on what the OECD guidance provides in this respect. Oki, over to you.
Thanks, Sanjay, and good day, everyone. So the OECD released the Chapter 10 of the OECD guidelines in February last year, and for the first time, we now have globally consistent guidance on financial transactions. And this chapter includes a specific section that deals with financial guarantees. Now, as Sanjay has said, one of the key elements of any analysis of guarantee fees revolves around the benefit that the guarantee provides to the borrower in that specific circumstance. And the OECD defines an appropriate benefit that would warrant a guarantee fee, a benefit of a lower cost of debt funding. So reduction in the interest rate is considered an appropriate benefit that would then warrant a chargeable guarantee fee. Now, there's various other benefits, and if you look at it at a high level from a commercial perspective, what a guarantee effectively does, it allows the borrower to borrow at the same terms and conditions that it would have had available to it in the event that it had the same credit rating or financial strength as the guarantor. Now, there are various different types of intra-group credit support that we see, and it's really important to understand the impact of the different types of benefits before we analyze and understand the price or an appropriate value for a guarantee. So we have explicit guarantees, and that's generally considered to be a guarantee that's legally enforceable, and it provides specific rights to the lender in the event of a default. And then the other type of guarantee that Sanjay has also referred to is implicit support. So that is essentially the level of support that is being provided, or the way that an independent lender would look at a subsidiary, purely because it's part of a broader multinational group. Now, under the guidance of the OECD in Chapter 1 on general group synergies, it's very clear that any of these types of benefits for just being part of a multinational group without a concerted effort by one of the group members, that is not considered to be a chargeable service. And the OECD extends that guidance specifically to guarantee fees as well. Now, in the real world, the implicit support and the explicit guarantees don't tend to happen in isolation. So there's often a combination of those two, and therefore it's important that we are able to distinguish the two types of benefits before we really start any pricing or valuing analysis. So as we go on to the next slide, there is this example in the OECD guidelines in Chapter 1 that has been there since 2017. We just put that into a picture here to illustrate the interaction between implicit and explicit support and the guarantees. So what we have here is an independent lender or bank that is lending funds to a subsidiary that on its own, standalone, would have a credit rating of BBB or BAA in Moody's terms. But because of the guarantee that's provided by the parent company, which is a AAA rated entity, the interest rate is determined based on AAA. So if we're trying to work out what the benefit of that guarantee would be, the starting point would be simply to look at the difference between AAA and BBB, and that's the savings as a result of the guarantee. But then the other fact that we have to take into account is even if that guarantee was not in place, in this specific example, just because of the implicit support or the halo effect, as it's known in the banking world, the independent lender would have considered subsidiary S to be to have a credit rating of single A, just because of that group membership. So if you look at the sort of the line right below the slide there, so the difference between BBB and A is purely based on implicit support. So that benefit is not recognized in determining an arm's length guarantee fee. The benefit that's being provided by the guarantee is what's in addition to the implicit support. So the difference between single A and AAA is what should be taken into account when we are valuing the guarantee fee. Now, this is not the only types of benefits that we see from guarantees. So if we move to the next slide, another benefit that can occur from a guarantee is that it may allow the subsidiary to borrow a larger amount of funds because of that specific guarantee. Now, the OECD is saying in those circumstances, there's a couple of additional questions that needs to arise. Firstly is whether that portion of the loan that would exceed the amount that the subsidiary would have been able to borrow at arm's length as a standalone borrower. So in this case, 60 million rather than 100 million. One accurate delineation of that arrangement could be that that should rather be considered as an equity investment of 40 million, and then the loan is recharacterized as only being 60 million, and then ultimately determining the guarantee fee based on the 60 million rather than on the 100 million. So I think the key fact here is it's really important, and it comes back to that original principle that the OECD is laying down, that the appropriate benefit for a guarantee fee is a reduced cost of funding. If you have other benefits, you may need to delineate or reconstruct the arrangement in a different way. If you go on to the next slide, just a few more points around the accurate delineation of the transaction. So the OECD makes the point that not all guarantees confer a benefit on the borrower, and there are certain cases where the guarantees are more a reflection of the interdependency of different entities within the group, and they don't actually necessarily add an additional level of support from an external lender's perspective. The other type of guarantee that we do see quite often, and we'll talk about that when we talk about the different countries, is a letter of comfort. Now, that is a non-legally binding letter, and the OECD's view is, in general, and it always depends on the facts and circumstances, but in general, if that guarantee is not legally enforceable, then it is more likely to be a reflection of that implicit support, and again, not a chargeable service that's being provided. It's also important to take into account the financial capacity of the guarantor, and that just comes back to the overall sort of substance requirements that we see in the OECD under the post-BEPS approach. But it is clearly important that the guarantor does have the financial strength to be able to act on the guarantee if required. And then finally, the OECD makes some comments around group-wide cross guarantees, and it comes back to that earlier point that they may just reflect an interdependency within the group rather than specific beneficial guarantees. And as a result of that, they may be akin to implicit support as well, or just simply too hard to price. So on pricing, if we go to the next slide, there's a few methods that the OECD is putting forward. So the first one is the CUP method, and as always, where information is available, the CUP method will be the most reliable methodology. The challenge we have is that guarantee fees, and especially the way that they play out within multinational groups, are quite rare outside of related party transactions, and they're very specific to the financial strengths of the entities involved. So it can be very challenging to find CUPs in the market. The yield approach really comes back to that example, and it focuses specifically on the reduction in the interest rate. So it's really looking at the amount or the interest rate that the subsidiary would have paid without the guarantee, and comparing that to the interest rate paid under the guarantee. And the difference between those two reflects the maximum that the subsidiary or the borrower would be willing to pay for a guarantee. Because obviously, if it's more than that, then you would just borrow directly without the guarantee. And then the rest of the approaches from the OECD Chapter 10 focuses on the cost of the guarantor. So from the guarantor's perspective, what would be the minimum return that it would require to cover the additional risks that it's taking on? And that could be looking at things like the expected loss through probability of default, and also the capital that it may need to hold. And sometimes we can look at guidance from Basel and the banking world to determine the amount of additional capital for that particular exposure, and then looking at a return on that capital that an independent guarantor would expect to earn. Similar with the last two methods, evaluation of the expected loss, and again looking at an expected return on that particular amount if you value that. And then finally, the capital support method looks at the additional capital or equity capital that the borrower would take on or would need to take on to have a credit rating that is aligned with that of the parent company, and then look at what's an appropriate return on that additional equity that it should earn. So Sanjay, on that note, I'm going to hand back to you, but that's just a brief overview of what we have within the new guidance from the OECD.
Oh, thanks a lot, Oki, for giving a peep into what OECD has to say on the questions of parental guarantees, including the transfer pricing method that can be applied. This brings us to the first polling question of the day, and the question is, what are the most common guarantee arrangements between the related parties in your group? And the possible responses that we have put up on the screen are explicit guarantee, financial guarantees, letters of comfort, performance guarantees, other, or no guarantee arrangements at present. So while we are waiting for the responses, let me ask a question to Oki. Okay, while we are waiting, from a practical perspective, what is the significance of having the specific OECD guidance on guarantees for multinationals?
Yeah, Sanjay, I think one of the key things that we've seen with this guidance, or in the absence of guidance on financial transactions for a long time, is that in that vacuum, various different countries are taking very significantly different approaches to various types of financial transactions. And specifically, we'll see that within our region, that there are countries that even some of the basic things are quite different. So it's very welcome to have that guidance that is globally accepted. And I think the other thing that's quite helpful for our region's case is that the OECD guidance has been endorsed by, it's not just the OECD countries, but it's the whole inclusive framework, 127 countries that's endorsed this particular chapter. So it certainly helps us to have that consistency as a starting point in dealing with tax authorities around the region.
Thanks a lot, okay. And the responses are there. Explicit financial guarantees, almost like 30% of the participants have said that they have that. Letter of comfort is also as popular, almost like 27, 28%. Performance guarantee is not that, almost like 1/3 of that. That's about 10.5%. Others are 5.8%, and no guarantee is about 12 to 12.5%. So that's a pretty good arrangement, and just justify that the financial guarantees, letter of comfort, and in some manner, performance guarantees are also being used as an instrument. So let me now invite Trina and ask her to take us through the related party transaction situations in various countries. And Trina, you are going to talk about India, China, Japan, Korea, and Hong Kong. So over to you, Trina.
Thanks, Sanjay. Indeed, corporate guarantees have often been neglected in the financial transaction space, and probably rightly due to its aligned complexities. In India, however, we cannot say the same, as there are more than 85 case laws in the tax tribunal. One of the common areas of dispute has been whether guarantees should be treated as an international transaction or not. Well, this confusion arose as before 2012, guarantees were mostly not reported even in the TP forms. Guarantees were rather treated as contingent liability and oftentimes not considered as an international transaction to be disclosed for related party disclosure purposes. However, this issue is more or less settled after 2012 when the Indian tax laws were specifically amended to include guarantee. That said, the Indian tax authorities have been aggressive on scrutinizing the outbound guarantees. The audit mostly revolves around the pricing and questioning the split of the benefit in most cases. Unfortunately, even with so many case laws at tax tribunal, no uniform approach or stated position has been observed, as there are contradictory adjudications at the tribunal level, and the apex court, which is the Supreme Court, has not ruled on this issue yet. India also has a safe harbor of 1% of the guaranteed payout, which generally perceived to be on a higher side, given that the guarantee fees accepted in the tax tribunal as of now historically have been observed to be in the range of 0.5 to 0.8% in India. Well, of course, subject to higher tax appeals. Even on the advance pricing arrangement front, APAs, I think we have observed that most MNEs prefer to settle their guarantee fee cases at the APA level. There are more than 8 to 10 cases which have been concluded on APAs of guarantees because it seems to provide more surety to the MNEs. In the next slide, we have broadly focused on the specific issues that are normally experienced during an audit in India. For inbound guarantees, we have generally not observed the tax officers to really question the need of a guarantee so far. So like OECD has mentioned about a guarantee being more akin to a condition precedent to a loan may not warrant a fee. Generally, such arguments or questions have not been raised by the tax officers for inbound guarantees so far. Similarly, this argument of condition precedent to loan is not appreciated even for outbound guarantees. So irrespective of condition precedent or not, they expect a charge. On the other hand, what we observed is at the tax tribunal level, there are cases which have been upheld where the taxpayer's position of guarantees being extended as part of shareholders' duty has been accepted, and no charge for such guarantees have been upheld. For example, I think in case of Britannia and Tega at the tax tribunal, the tax court mentioned corporate guarantee as a shareholder activity was provided to the subsidiary, and the primary objective was to help its affiliate and protect the interest rather than earning an interest income or guarantee fee. Like in most other transactions, the other contentious issues is the pricing bit. Now there, what we have seen is a gradual shift in the approach of the tax office. Generally, earlier, transfer pricing officers in India used random bank codes. It may still be prevalent, but this practice has reduced after the High Court, in case of Everest Kanto, made an observation distinguishing a corporate guarantee and a bank guarantee, or a bank quotation for that matter. This position further got strengthened as OECD also made a similar observation in the financial transaction paper, where bank codes which are not consummated transactions were not encouraged as CUP. Currently, in fact, we have observed that the tax office rely on the yield approach as termed in the OECD paper, or otherwise commonly known as the interest-saved approach. In many cases, they are also applying loss-given default approach or similar approaches to derive the expected loss. In one of the recent audit cycle, we witnessed application of the sophisticated Hull and White model to price guarantees. This generally the tax office use for both performance-based as well as financial guarantees. We discussed about letter of comfort and support. Well, though the OECD has distinguished it clearly, the Indian tax authority's position is somewhat not very clear. Definitely, there is an acceptance of the fact that these arrangements are not completely a guarantee agreement, because even when the tax office determines the ALP, it is generally lower than what they would otherwise do for a guarantee transaction. But nevertheless, they still believe that it warrants a charge. The tax tribunal, though, has provided a clear direction by not treating these as guarantees. Like in two of the prominent cases, in Tata International case and in Asian Paint case, they ruled similar to what OECD has mentioned. But again, the Apex Court's decision would be important in this regard to have a final position for audits. So yes, innovative approaches are being explored by the tax office, which is both promising and also at times can pose challenges if not applied appropriately. Well, with no stated position and uniformity in the approaches adopted during audit, we could only say there is more litigation in this area in India. In the next jurisdiction that I'm going to cover, which is Japan, well, like India, though not in the same proportion, the National Tax Agency of Japan, NTA, also focus on Japan-headquartered multinationals, which may not receive any or significant guarantee fees extended for the benefit that they provide to their foreign subsidiaries. Again, in terms of pricing, interest-saved approach or the yield approach is more commonly applied by the tax authorities. And I think generally the taxpayers would also adopt the same. And the question that mostly revolves in Japan audits would be, again, how appropriately the benefit or interest saved is derived and how such benefits are being split. Post-release of the OECD paper, there have been no specific update or guidance, so to speak, issued by the NTA on financial transaction. Therefore, definitely it will be interesting to observe how OECD methods will be adopted by NTA in future, if at all. Speaking of letter of comfort and letter of support, I think a parallel can be drawn from that of the position in India. Letter of comfort have been challenged as NTA consider even LOC as an extension of corporate guarantees and there is a requirement of payment for benefit received by the foreign affiliates of the Japanese taxpayer, even for LLC. Going to the next slide. In China, what we have observed is the State Taxation Administration, or STA, has been in particular not vigilant about the guarantee transactions. Again, whatever they are looking into are mostly for the outbound local entities providing guarantees, and of course domestic guarantees as well. Normally CUP is accepted, and typically that is considered a part of CUP, or a comparable bank quotation is also generally accepted. The STA has not issued any specific guidance for OECD financial paper. Again, that will be interesting to wait and watch. But we are given to understand that they are evaluating the OECD guidelines, exploring the application of valuation of expected loss approach in pricing the guarantee. There have been limited experience of tax audits so far, or scrutiny, so to speak, on performance guarantee or letter of comfort. Interestingly, in Hong Kong, well, it's actually too nascent to comment on how IRD would approach on guarantee transactions, given the contemporaneous transfer pricing documentation requirements have just started post-2018. So far, there has been no such tax scrutiny in this area. Well, one more common issue of guarantee fee income in Hong Kong is whether such income should be HK onshore or offshore income. Oftentimes, that issue is more controversial point in local audits than the income amount or the guarantee fee itself. Well, going to the next slide. One of the other jurisdictions where guarantee has been contentious is Korea. Much before the OECD paper, the Korean Ministry of Strategy and Finance has issued guidance on the pricing of guarantee fees to Korean parent companies by its overseas affiliates. So again, the focus is on outbound more. Effective, I think, January 1st, 2013, Korean taxpayers were required to comply with new rules on the pricing of cross-border guarantees between related parties. A new clause was introduced where there were specific methods which were mentioned for determination of ALP of a guarantee. A method based on guarantor's expected risk and cost, a method based on guaranteed entity's expected benefits, or a combined approach where both the above methods could be looked together. There is also a safe harbor, in fact, two safe harbor provisions. If those are followed, then the guarantee fees are generally deemed to be at arm's length. Guarantee fees, which are computed based on the difference between interest rates with and without a loan guarantee, when the interest rate difference is calculated by the finance company providing the loan in question. One key catch is that the fee should be limited to the amount confirmed through the interest calculation report prepared by the finance company extending such loan. And if the guarantee fee has already been computed in accordance with the methods and condition prescribed by NTS Commissioner. Now, there are certain things which we have to be careful about. The technical details of how this NTS model actually operates have not been publicly disclosed. However, it is understood that preference is there to determine credit rating using web-based tools such as RiskCalc or S&P. Mostly RiskCalc is what we understand is being followed. Well, the NTS press release documented that they definitely follow a systematic approach through which the guarantee fee may be determined. In fact, it's interesting that there is a mention of both the expected loss approach and the interest saved approach, which we now see being mentioned in the OECD. So that is all about these jurisdictions. Sanjay, back to you.
Oh, thanks a lot, Trina, for giving such an overview of 4 or 5 countries in the AP region and giving us a comparative picture. That was very helpful. Thanks a lot. So let me now pose the second polling question, which is there on the screen. And it says, based on your experience, what has been the primary objective of financial guarantees in your group? And the possible responses as shown on the screen are to have better interest cost. Parental guarantees ensure lower borrowing cost. Guarantees are more in the nature of condition precedent, so no explicit interest reduction benefit has been observed. And the third one is not sure or not applicable. Let me ask you, Trina, one question which came to my mind. Can the letter of comforts and support be categorized as guarantees? Because we heard something on the OECD, and then you talked about on all these countries. So how do you see that?
It's a good question, a tricky one indeed, Sanjay. As OECD mentions, I think Oki mentioned that OECD mentioned that anything which is less than a legally binding commitment involves no explicit assumption of risk. Mostly, in my experience, though, we have seen that letter of comfort or support can be classified under such arrangement, which is not legally enforceable. However, it's not a one-size-fits-all answer. We need to evaluate each and every transaction separately. One common approach I would follow is to check whether such letter of comfort is legally binding under jurisdiction's contract law, maybe, and whether any obligation can flow back to the guarantor, given the language of the letter of comfort or support. That could be a good check to conclude whether it could be classified something very similar to a formal guarantee.
Oh, thanks a lot, Trina. So the responses are also there. Say better interest cost attracts almost like 41%, which is very high. Guarantees are more in nature of a condition precedent, which is also 36%, almost at par with the other one, better interest saving, better interest cost. I'm not sure is about 23, 24%. So that is the result that we have on the screen. Let me now turn to Avik and Thep and request them to give their perspective on Singapore, Malaysia, Vietnam, Philippines, and Indonesia. Avik, over to you first, and then you can transition to Thep after you finish Singapore and Malaysia.
Thank you, Sanjay. Hello and good day, everyone. So continuing with our discussion on specific countries, we shall now focus on the Southeast Asian region. I'll be speaking on Singapore and Malaysia first, followed by my colleague Thep, who will cover Indonesia, Philippines, and Vietnam. So starting with Singapore first, when it comes to corporate guarantees, the approach of the revenue authorities here has been quite rational to date, without much transfer pricing audits centered around this transaction type. Under Singapore TP rules, there is a requirement for taxpayers to prepare TP documentation for related party guarantee transactions if the total value of the guarantee income or expense is greater than 1 million Singapore dollars. So this shows that the IRS in principle recognize that related party guarantee arrangements should take place at arm's length price. And it is definitely within their ambit to investigate such transaction from a transfer pricing perspective. Well, when it comes to related party financial transactions in general, IRS have focused more on intercompany loans rather than on guarantees. This is also reflected in the guidance that has been issued by the IRS, and specifically giving direction on pricing loan transactions. The current edition of the TP guidelines include detailed discussion about pricing of related party interest, but no such similar guidance has been set out for whether corporate guarantees or financial guarantees. When pricing guarantees in practice, we have seen the IRS have typically been agreeable to use the yield approach. As Singapore is part of the OECD inclusive framework, the IRS generally take guidance from the OECD TP guidelines. Going forward, we would expect IRS to take a similar approach within the recent OECD paper on financial transaction, which was released and Oki just touched upon. So therefore, when it comes to pricing guarantees, it should be possible to rely on all of the approaches set out in the OECD paper, though IRS is yet to formally come out with any guidance or direction on this. We are expecting IRS to release an update of the Singapore TP guidelines within the first half of this year. And this may include updates to the existing guidance on financial transactions following the OECD paper. Talking about related party performance guarantees, though to the best of our knowledge, there has been no instances yet of an IRS audit or query. One needs to evaluate whether there is a benefit accruing to the related party from the performance guarantee extended by the other group entity. Based on the OECD's TP principles, such benefits need to be paid for and priced at arm's length in case third parties would have done so under comparable circumstances. Therefore, it is a need to first determine the benefit conquered and then appropriately price such benefit. Again, of course, it is advisable to make use of one of the methods prescribed under the OECD guidelines for the performance guarantees, even in Singapore here. Talking about letters of credit and letters of comfort, these are generally not considered as explicit guarantees in Singapore. And as Trina mentioned earlier, given the lack of explicit contractual obligation, ideally there should be no question of a guarantee fee in these cases. Of course, whatever position and stand taxpayers take, this should be well documented in the form of a transfer pricing report. With that, let me now focus on Malaysia. So next slide, please. Okay. As you will note from my subsequent discussions on Malaysia, the situation here is quite different compared to other countries. In Malaysia, transfer pricing is applicable for both domestic and cross-border related party transactions. This causes a potential in-country double taxation issue for Malaysian taxpayers when it comes to corporate guarantees. This is due to the position taken by the local tax authority, which is the IRB, wherein Malaysian borrowers may not be able to get deductions for guarantee fee payments, while the guarantee fee income for the Malaysian guarantor would still be taxable. And the issue of related party domestic guarantees has increasingly been under the focus of the IRB. For Malaysian borrowers, the IRB's position is that financial guarantee payments are not deductible for tax purposes, especially non-financial services taxpayers. This is on the basis that the IRB states that these expenses are capital and not revenue. So this is the view of the IRB. However, in the courts, we have seen decisions go both ways for taxpayers. As these case decisions have only been at the high court level, they have not set precedent for future cases. And deductibility of guarantee expenses remain very uncertain over there. So given the uncertainty, non-financial services clients or companies typically take a prudent approach and do not take a deduction for the guarantee fees. Nonetheless, I mean, through our practice, we are aware of a few taxpayers who have taken the position where they have claimed deduction for these expenses. For foreign guarantee fee income, which is like inbound income into Malaysia, there is less of a double taxation risk as the country may be treated, as the income may be treated as a foreign source. Of course, subject to certain conditions being met, the foreign sourced income is not taxable in Malaysia. However, under the new TP rules issued, which I'll come to in a moment, there may be potential TP implications in case the guarantee fees are not structured at arm's length. the IRB have not released any formal guidance on approach for pricing related party guarantees. We expect them to follow the principles set out in the 2017 OECD guidelines and the 2020 OECD paper on financial transactions. But in practice, both the yield and the loss given default approaches are used for pricing. But the yield approach, I would say, is more common than the loss given default approach. Again, coming back to the recent development which I mentioned, is that the new TP rules have been announced in Malaysia with effect from 1st of January 2021. Broadly speaking, under these rules, there are financial penalties for failure to provide TP documentation to the IRB within 14 days. And a surcharge of up to 5% may be levied on any transfer pricing adjustments made by the IRB. What this means in the context of domestic guarantees is that there is a risk for Malaysian domestic guarantors if they are not currently charging a guarantee fee, and the IRB challenges that a guarantee fee should be charged. If the IRB is successful, the taxpayers would then be liable for not having prepared TP documentation for the related party transaction, and a surcharge could be applied on the transfer pricing adjustment. These new penalties are also expected to be applied retrospectively for historic periods that are still open for audit. When it comes to performance guarantees or letters of comfort, the IRB, like we've seen in Singapore, have not typically focused on these types of related party arrangements yet. So this is in a nutshell about Singapore and Malaysia. Now I hand over to my colleague Thep, who will discuss about the same transactions on the other C region countries. Over to you, Thep.
Thank you, Avik. So unlike some of the other jurisdictions we've covered today, we've not really seen the local tax authorities in the SEA region historically audit many financial guarantees. So focusing on Indonesia, Philippines, and Vietnam in today's session, the approaches seen in these three jurisdictions are broadly representative of the approaches by the tax authorities across the region. So the local tax authorities in Indonesia, Philippines, and Vietnam to date have not released any specific guidance on the approach for financial guarantees. As such, it's likely that the approach set out in the OECD guidelines would be followed by the tax authorities when they price financial guarantees. However, again, to date, none of the tax authorities in the region have released any guidance on this. In practice, where taxpayers have related party financial guarantee transactions, the local tax authorities have generally been agreeable to pricing financial guarantees using the yield approach, such as in Indonesia, where in practice we have predominantly seen this approach used by the local tax authorities. However, there may be some slight local variations in how the yield approach is used between countries. So, for example, in Vietnam, the typical approach is to compare the total interest expense, including the guarantee fees, against the Vietnam Central Bank borrowing rate. With respect to the other types of related party guarantees, there's not really been many audits by tax authorities in the region for these types of transactions. So hopefully this has provided you with a brief and useful overview of the approaches of the local tax authorities in the Southeast Asia region to guarantees transactions. The takeaway message for guarantee transactions is that historically, we've not seen many tax authorities inquire about these transactions, but based on the experience of our colleagues in these regions, there are local variations that when it comes to pricing, and these should be considered to ensure that the approach adopted is consistent with tax authorities' expectations. So I will now hand back to Sanjay for the next part of the session.
Well, thanks a lot, Avik and Thep. Between two of you, you have covered many questions and given us a very summarized view of each of the countries. That was very helpful. Thanks a lot, Avik and Thep. Let me now turn to the third polling question, which is there on the screen. And the question is, have you directly faced challenges from local authorities on related party guarantee transactions? And the responses are yes, no or do not have related party transactions. Avik, let me utilize some time while the responses are coming, and let me understand how the SEA region, most tax authorities are, as you said, are not historically focusing on related party transactions. But with the release of OECD guidance on guarantees, do you see the approach of tax authorities in the region changing with a closer scrutiny of each transaction?
Yeah, Sanjay. So generally, over the recent few years, we have observed that the local tax authorities in the C region have become increasingly more sophisticated with respect to their TP audits and queries. So this is a trend that we expect will continue. Therefore, whilst we have not seen many audits by the tax authorities of related party guarantee transactions, it is highly possible that this could change. And especially because of the release of the OECD paper accelerating this. However, with the release of the OECD paper, it hopefully leads to more consistent approach across the jurisdictions and provide a sound technical framework for the basis of discussion about pricing the guarantee fees between taxpayers and local tax authorities. The anticipated increased scrutiny on related party guarantees by local tax authorities could also possibly be accelerated in the aftermath of the COVID-19 pandemic. This is because due to the effect of the pandemic on many businesses, tax receipts across all jurisdictions are likely to be significantly reduced compared to prior years. And therefore, the local tax authorities would most probably be scrutinizing these files more closely, thereby increasing the probability of even corporate guarantees and other financial transactions getting scrutinized and picked up for audit.
So, Avik, what you just mentioned, I can see that on the screen that only 26%, that is 1/4 of the people who filled up their responses, say that they have found some kind of direct challenge. But almost like half of people do not seem to have done that. So that's a pretty in line with what you just mentioned. Let me now turn to Oki to invite him to give a perspective on how Australia and New Zealand are treating this topic. Oki, over to you.
Thanks, Sanjay. So in Australia, just from a technical point of view, the OECD guidance in Chapter 10 has not formally been included as part of the guidance in the legislation here, but we expect that to happen sometime in the near future. Unlike India, we haven't had any specific cases on guarantee fees focusing on these types of transactions, but I think many of you would be aware of the Chevron case that was concluded about 3 years ago. That was quite a big inbound financing arrangement. And in that case, some of the principles that came out from the judgment there would apply to guarantee fees as well. For example, the status of a guarantee or of a subsidiary, implicit support, and just the way that the court was able under the legislation to reconstruct some of the terms and conditions within the loan. A lot of those principles would also apply when we are looking at the guarantee fees within Australia as well. Now, from the ATO's perspective, they've been very clear, and the Commissioner is on record that cross-border financing arrangements is the #1 tax issue in Australia. And their focus is primarily on inbound arrangements. And over the last few years, we've seen a significant increase just in their capacity and their investment into this area, as well as detailed guidance on a number of financial transactions, including loans, guarantees, interest-free loans, that's come out in the last 2-3 years. And the ATO is very specific and granular on the way that they approach these transactions from a risk assessment point of view. What we haven't seen yet is anything on guarantee fees, and from our discussions with the ATO, they do not have an intention to publish anything in the near future. But what we do know is they are working through a number of large audit cases in this space, and I'm guessing they're still developing their views and their approaches as they work through this process. In terms of the focus areas that we've seen from the ATO, just in our interactions with them, it's really looking at three key questions. And the first one is whether a guarantee would exist between independent parties. And the question the ATO often throws at us is just, do you have any comparables? Is there anyone else in the market that's doing this? And like I said earlier, it can be quite hard to find control, so CUPs or similar transactions in the market that we can use. So that tends to be the first challenge from the ATO. And then the second one is going into what we've discussed across the board, focusing on whether a benefit has been conferred on the borrower. And again, very big emphasis on implicit support and requiring taxpayers to be able to demonstrate that there's an additional benefit on top of that. And then finally, once that has been established, they would then go into looking at the pricing of the guarantee fee. As I said, no specific guidance around methodologies, but from our experience, the starting point tends to be the yield approach. And then just finally, what we're seeing from the ATO is that any guarantees on the related party debt is unlikely to be accepted. So and I guess mostly with the multinationals, we tend to see guarantees on third-party debt, but they certainly would challenge anything on a related party transaction as such. As we move on to New Zealand on the next slide. Now, in New Zealand, the OECD guidelines, Chapter 10 has been endorsed by the Revenue Authority there, the Inland Revenue. However, one of the key things in New Zealand that's happened over the last few years is the introduction of the restricted transfer pricing rules for loan arrangements. So under these rules that came in 2018, Inland Revenue or under the legislation, taxpayers are required to price their intercompany inbound loans on a basis under very sort of restricted and deemed terms and conditions. So any exotic features are carved out. There's a very prescribed methodology to determine the interest rate. So for certain types of loans, those rules will apply. So it's important to understand and think through the interaction between those rules and then any guarantee arrangements that are in place for the same borrower. The Inland Revenue has also provided some guidance on their website, so it's relatively high level. But some of the things that they put forward there is that an explicit written guarantee is required for a guarantee fee to be recognized. So we've spoken a lot about letters of comfort, and the Inland Revenue is very clear that that would not be accepted to warrant a chargeable guarantee fee. They also put forward their view that in most cases, they would consider that there would not be any additional benefit from an explicit guarantee over and above implicit support. So if we think back to our earlier example, from our early starting point, tends to be that everything comes down to implicit support and there's no additional value and therefore no guarantee fee should be charged. And then finally, and this is quite interesting because guarantee fees are not covered under the restricted transfer pricing rules, and this has not been tested, but OED's view on the website is that the total cost of the arrangement, so the interest paid plus the guarantee fee, should not exceed the deduction that is available under the restricted transfer pricing rules. So that, in a nutshell, Sanjay, is what things look like down under. Like I said, very much focusing on inbound guarantees, and then both tax authorities focusing a lot on the benefit and whether a guarantee fee should be charged to begin with before we get into any discussions around pricing. I'll pass back to you, Sanjay.
Thanks a lot, okay, for the country brief on Australia and New Zealand. And thanks a lot, Avik, Trina, and Thepin for country presentations. And all these presentations have given a kind of overview on how various countries are applying the transfer pricing rules to the financial guarantees. And of course, there are variations in the emphasis. And this brings us to the end of our today's discussion. We now have some time to respond to some questions from the audience. So, okay, I'll take the the question which has come from the audience, and the question is on whether the two authorities, and I guess it will be Australia and New Zealand, place an emphasis on benefit derived from a guarantee. What are a few things that the taxpayers can do to support that benefit, that a benefit exists? Okay.
Yeah, and I think that can be quite a challenge for taxpayers, especially in this environment where there's some skepticism from the tax authorities. I think that the first one would be just recognizing that in most cases with a guarantee fee, there is a third party involved. So a third party lender or a bank on the other side, so any correspondence, agreements, etc. with that entity would be helpful in demonstrating the benefit. I think the other thing is what we tend to do and see when we're preparing transfer pricing reports for guarantees is we tend to spend a lot more time on that benefit piece. So if you compare it to a normal management service, where that can be relatively straightforward, in the guarantee fee analysis, we really have to go through the credit rating and implicit support and economically establish the value of each of those elements in the analysis.
Thanks a lot. Let me attend to another one question, which is, I think is for would go to Avik. Avik, what do you see as the most important factor in ensuring robust defense of related party guarantees against challenges from the SCA region tax authorities?
Okay, so for this, Sanjay, of course, but this is true for all related party transactions anyway. It is important that appropriate transfer pricing documentation tailored to the local requirements and practices. So the TP documentation is normally the first line of defense in any audit scenario anywhere. So therefore, it is vital that local TP documentation is prepared, which clearly lays down that foundation of the transaction, discusses about the nature of the transactions, pricing, and appropriate methodology, and benchmarks the transaction using one of the recognized approaches in the local jurisdiction. So in a nutshell, it's the documentation and how substantially you have prepared that documentation would be very, very helpful in this case.
Thanks a lot, Avik. That is all we have time for. Avik, Trina, Okay, and Thep, thanks a lot for your useful presentation and answering questions. My special thanks to all of you in the audience for joining on this webcast. We would like to encourage you to fill out a short survey that will pop up on your screen momentarily. And please tell us what you think about today's program. If you joined us late, please note that this presentation will be archived for future viewing. If you feel that others would benefit from this webcast, please share the webcast via the share this icon or have them visit the debriefs website. We will respond to all the other questions submitted during the webcast in a couple of weeks. And also, if you think of any other question or comment later, please feel free to reach out to either to me or to any of the speakers. We would be more than happy to talk to you. And also, please do not forget to tune in to our next scheduled webcast from the Geography Update series on March 2nd, which is titled Regional Incentive Policies in China, New Growth Opportunities. So at last, from all of us at Deloitte, thank you for your participation in Deloitte's Asia Pacific Tax Webcast today. Goodbye, and thanks a lot.